The Federal Reserve's Jay Powell has finally said that the time has come to cut rates. He's noticed that the labor market is getting a little weak. It's cooling down a little bit. Meanwhile, inflation is already quite low. It's down below 3%. So according to Jay Powell, our Fed chair, he is now saying that the calculation has shifted. Things have changed. We're no longer focused solely on bringing down inflation. Now the risk of the labor market doing worse, even worse than inflation, has become greater. So the time has come to cut rates. But what does this mean exactly? What happens when we cut rates? So far, over the past couple of years, we've seen interest rates go from nothing, from 0.08 federal funds rate, all the way up to 5.3. This is a record high increase, a record fast pace of increasing interest rates. And now we have the Fed chair announcing that they're going to go back down. What does this mean for companies? What does it mean for our portfolio? What companies will do well because of this? Which ones will do poorly? We're going to be breaking down all of this and going over the impact that rate cuts will have on the market. Now, we also have some other news. Intuit reported earnings. Apparently, the market thinks that Intuit's earnings weren't so great. Well, I disagree. I really like the earnings, and I bought $5,000 more of Intuit this morning. We'll be going over the earnings, breaking it down with the data, looking at what happened and what they're projecting. And we'll be going over why I think the stock is a buy. Now, we also have some other news to get to that's rather bizarre. This is the type of news that I would not guess in a million years. I'd never be able to predict it. It comes so far out of left field, it just seems totally random. Chick-fil-A is reportedly launching a streaming service for some reason. That's what the actual news report says. Now, I verified this because, again, when I first heard this, I thought it was so weird. It was so bizarre that I thought it might be a joke. I thought it might be just fake news or parody. This is real. Chick-fil-A is starting a streaming service. So naturally, I got very intrigued. What is going to be on the streaming service? What is the game plan here? What does this mean for companies like Netflix and Paramount Plus? What is Chick-fil-A doing? We'll be addressing that in this episode. Now, we start off by jumping into the main story today, which is the Fed meeting in Jackson Hole. This is a highly anticipated meeting that all financial markets have been looking forward to for weeks now. For the past couple of days, we've been talking about this and seeing it on CNBC and the Wall Street Journal and the Financial Times and Bloomberg. The highly anticipated Jackson Hole meeting. Now, if you're wondering why they actually meet in Jackson Hole, they meet in Jackson Hole because in the early 1980s, the Kansas City Fed leaders learned that the best way to ensure that the Fed chairman, Paul Volcker, would accept an invitation to meet was to locate the premise in somewhere that had good fly fishing. Now, after that initial meeting with Paul Volcker and the good fly fishing, it's become tradition. So the reason that the Fed goes all the way to Jackson Hole, Wyoming, is specifically for fly fishing. And that's where we get some of the most important monetary policy laid out for us. Now, in this meeting, the Federal Reserve Chair, Jerome Powell, gave his strongest signal yet that interest rate cuts are coming soon, saying that the central bank intends to act to stave off further weakness in the U.S. labor market. Quote, "We do not seek to welcome further cooling in labor market conditions. The time has come for policy to adjust." Now, normally when you're reading Fed statements, you have to read between the lines. You have to figure out what they're really trying to say. But that's not the case here. Jerome Powell is coming right out and saying it clear as day. The Fed is ready to lower rates. There needs to be a change in direction. He goes on to say, quote, "The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks." He didn't say exactly when, he didn't lay out exactly what quarter or what month they'll do it, but we know that rate cuts are going to happen and they're going to happen soon. Now, the reason that the Fed is deciding to pivot today is because the Fed has dual mandates, meaning they have two different things they're focusing on. One part of their job is price stability. Price stability means that you don't have runaway inflation, that you don't have deflation. It means that you have stable prices, that your dollar today will be able to purchase around the same amount of stuff tomorrow and next year and the year after. The target range for the Fed in terms of inflation is what they call a symmetric 2%, which means that year over year, your purchasing power can purchase about the same amount minus 2%. So you have around 2% inflation, give or take, year over year. If one year it's 1%, one year it's 3%, you have a symmetric 2%. A little inflation is a good thing. It's good for the national debt. It's good for price stability. It's better than deflation. So that's what they like to focus on. having 2% inflation, and right now we're below 3%. So we're right close to that 2% goal. And in terms of where Jerome Powell sees things, he says clearly that we haven't completed the task here. We still have a little bit to go. It's going to take more time, but we're pretty close. Inflation's not a big deal anymore. Prices are still high, but inflation means that prices continue going up. And from today, prices aren't going up that quickly. They're only going up 3% year over year. So that's one part of their mandate. The next part is keeping stable employment, making it so that people looking for jobs can find employment. And this is where we're starting to see cracks in the data. We're starting to see an increase in the amount of people looking to be employed. Now, Jerome Powell was very clear here as well. When he went through employment, he said that the problem with the jobs data is not because companies are firing people. It's not like there's massive layoffs across different companies. There have been slight cutbacks, but nothing unusual. The problem with the job market is not that people are being let go, it's that there's a lot of new people looking for work, people entering into the job market. The unemployment rate is only including people actively looking for work. So if you're not in the employment market, if you're not seeking jobs, if you're not even looking for one, then you're not considered unemployed. Unemployed people are people looking for work that can't find work. And the amount of people looking for work is increasing rapidly. So we have an issue here where now the mandate and the focus of it has shifted. It's shifted from price stability to employment. And that shift means that it's time to take interest rates down. Because a primary tool the Fed has to help people find work is interest rates. It's a blunt tool, but it does help in this case. Lowering interest rates should increase the amount of jobs. And Jay Powell is optimistic here. He thinks that things aren't so bad. He says, quote, with an appropriate dialing back of policy restraint means high interest rates, 5.5%, there is a good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. That would be the best of both worlds. Having a strong labor market and 2% inflation. That is the Goldilocks scenario. That is the soft landing. And that's exactly what Jay Powell's looking for. Now, with these comments from Jay Powell saying that he's lowering interest rates, that it's time for change, we already have the markets pricing this in today. And you'll see the markets reacting and the bond market reacting in different ways. For example, right now, most Fed officials and most investors agree that there's going to be a cut in September. There'll probably be a 25 basis point cut. So a 0.25% interest rate cut in September looks very likely. I agree with this, and I think this is going to be the start of the interest rate cuts. Now, if we give the interest rate some context, this line here is the effective federal funds rate, meaning it's basically what the federal funds rate is at the time. Now, if we go back to 2009, you'll notice that it's near the x-axis here. It's so low. It's basically zero. We have zero effective interest rates from 2009 to 2016. And this is like investing in easy mode. It is like selecting the easiest mode on a video game. It's really forgiving. The reason that it's so easy is because interest rates directly impact the relative value of stocks. If interest rates are 5% and you can buy a risk-free treasury for 5%, it makes the bar of buying a stock all the higher. Because now you need to buy a stock that will outperform a 5% treasury. So you're comparing and contrasting every investment to that risk-free rate. If interest rates go up to 8%, well, that's even tougher. Try to find a stock that will outperform an 8% risk-free investment. That's really tough to do. So you can see that the higher and higher the federal funds rate goes, from 3% to 5% to 7 to 10, the higher and higher the risk-free treasury yield is. Treasuries go up from 3% to 5% to 10%. And then every single stock, relatively speaking, is less attractive because you have this investment over here that's looking better and better risk-free. So everything with investing is relative. The value of a stock is relative to the federal funds rate. That's why Warren Buffett says that interest rates are like gravity. As interest rates go up, it pulls down the relative value of all other assets. It's so important in everything we do. It has a major impact in all of the financial markets. It is the most powerful tool that the Federal Reserve has. Now, at the current time, we have interest rates of 5.3%. Now, 5.3% is nothing insane. It's not 10% returns risk-free, but it's still enough to make it so that it's relatively competitive against stocks. Many investors have been buying treasuries because they're getting a nice yield. In my savings account, I get a 5% yield. That's pretty great. So a lot of my money might be in savings accounts, and a lot of investors' money is in savings accounts, risk-free, instead of in the stock market. So as this interest rate goes down, and as saving yields go down, and as treasury yields go down, stocks become relatively more attractive, and more investors will be likely to take on the risk of stocks. We can see that during this time period, from 2009 to 2016, this was with relatively no competition for stocks. There is no alternative. Buying treasuries at that point was very expensive. The cheapest thing in the financial market were stocks. So investors during this time period, it was like they're investing in easy mode. They had it very easy. You could buy almost anything and it would go up. This time period that we're investing in has been much more difficult. You have to buy the right stocks. You have to buy companies really growing their earnings. There's no easy mode here. But as interest rates go further and further down, investing in stocks becomes easier and easier and easier. This also doesn't impact stocks equally. Some companies get impacted much more than others when interest rates go up and down, especially leverage companies or companies that are reliant on consumer financing. So when we look at the type of companies that I think this will have the largest impact on, it's ones like Vici. Vici is a company that very much competes with treasury yields. A primary reason that investors invest in REITs is to get that juicy dividend yield. Right there, the dividend yield of 5.14%. Well, why would investors buy a stock, a company that needs to be managed and run, when instead they could just buy a treasury bond or put their money in a high yield savings account? See, it's relatively difficult to argue for Vici when you have a high yield savings account. And that's why the stock so far year to date is only in the green by 0.43%. But as interest rates go down, this dividend yield stays the same. So it becomes relatively more attractive. And you can see this already being priced in the past month. Vici has way outperformed the market over the past month because there's greater anticipation of interest rates coming down. My expectation is that as interest rates continue to come down, Vici stock will go back up to $35, $36, maybe even back up to $37 per share, depending on how much interest rates come down. Other companies that are going to be impacted to a huge extent, and you can already see them reacting today, are ones like Tesla, because the great majority of Tesla customers rely on financing. They have to go to a bank, they have to ask for a loan, and then they get an interest rate on that loan. Higher federal funds rate means higher interest rate means the car is more expensive. So the interest rates determine to a large extent how expensive Tesla's product is. When interest rates went up dramatically in a single year, Tesla had to combat that by lowering prices on their cars over and over again the entire year. Lowering prices has caused Tesla's operating margins to drop dramatically. It's first level thinking that if interest rates going up cause Tesla to lower prices, then interest rates going down gives Tesla a bit more pricing flexibility. And this is the same for any company reliant on consumer financing. Companies where the customer has to go out and get a loan to buy the product the company sells. So we can look at any of them today. We can look at Home Depot. How's Home Depot doing today? Well, it's beating the market dramatically. It's up almost 2%, while everything else is up only 0.5%. We can look at Lowe's. Why are Lowe's and Home Depot up so much today? Because to do big home projects, to buy homes, to do anything with homes, it requires a lot of financing. Customers aren't paying out of pocket. They're not paying with cash. We have Pool Corp. Pools are expensive. You want to get a pool? Most likely you'll need a loan. So Pool Corp is up above the market because it's reliant on consumer financing. We can look at examples like Sunrun. I'm guessing, and that's not right. Is it RUN? Sunrun. Yes, the solar company. I'm guessing that every solar company bounced big today because solar is a product that nobody is buying in cash. They're financing it. So any of these stocks are going to have a good day. It's up 6% today. So as you're looking at different companies, the biggest differentiator in performance today is going to be companies that are reliant on consumer financing and ones that aren't. Ones that aren't going to be affected by this news. For example, we can look at Netflix. Netflix is in the red today because Netflix doesn't care about interest rates. It doesn't impact Netflix at all. Interest rates going up didn't hurt Netflix. Interest rates going down doesn't help Netflix because nobody finances their Netflix subscription by taking out a loan from the bank. So companies like this are not going to be impacted. Companies like Vici, Sunrun, Tesla, Home Depot, you name it. Ones that rely on big projects or consumer financing are going to have a good day. Now moving on, we have a company in my portfolio, specifically in my passive income portfolio here. It's in the financial category, which is Intuit. Intuit reported earnings yesterday, and it was after market close. Initially, the stock went up around 2% after reporting earnings because they beat on everything. They beat on their earnings per share, they beat on their revenue, they even beat on their full year guidance. But then something during the call caused the stock to go down. And that was because of their fiscal Q1 forecast was lower than expected. So as of right now, the stock is currently down 7%. It's flat year to date. It's up just 1.6% and it pays a small dividend. Now, when I look at this position, with the stock going down after this earnings, I decided to buy $5,000 more of Intuit. That buy went through this morning. If we look at what's going on with Intuit, the first thing I say every time I have a company where the stock goes up 7 to 10% after earnings, or it goes down 7 to 10%, is that should not inform you of how the company is fundamentally doing, what direction the company's moving, and what the future value is. A lot of this type of trading immediately after earnings is driven by big institutions, it's driven by bots, it's driven by options and leverage. There's a lot of other factors that drive very short-term trading results. So I don't use this as an indication to say that Intuit's doing poorly. Intuit's gaining in market share. It's in an increasingly strong position. If we look at the breakdown of their revenue by segment, which this is updated as of last quarter, we can take a look here and see that it's steadily growing. We have 13% growth across all segments. That's the total revenue of the company. That's fast top-line growth for a company of this size. Now, if we look at the different segments, we can see that Credit Karma is struggling. This is one where they had explosive growth in 2022. It slowed down a bit, and now they're starting to regrow this section. Credit Karma is a valuable asset that's being plugged into different parts of the business. So even though this is flat, I still like this segment of business. The Pro Tax section is also slow growing. We have the consumer category, which is growing a little bit faster, but still below the average of the company, 7.5%. So all of these three segments are not growing as fast as I would like, but the main thing they're focusing on is this segment right here, small business and self-employed. This is the QuickBooks section of their company. It's the biggest segment and by far the one with the most growth opportunity. This is the one where they're putting the most effort in developing a fully fledged CRM, very similar to Salesforce, but for smaller businesses. You can see the rapid growth year over year, 18.6% in this segment. And they're incorporating AI into all different aspects of this business. A lot of people still incorrectly view Intuit as a tax company, but that's becoming an increasingly smaller portion of their revenue. The greater portion that's growing the fastest is their CRM for small businesses. They're becoming a fully fledged management tool for small businesses, and they're integrating AI into everything they're doing. On the earnings transcript of this most recent call, the CEO of the company emphasizes how much they're focusing on AI. It's the first thing he brings up. Intuit is a global AI-driven expert platform that is powering prosperity for consumers, small and mid-market businesses. Our strategy and 5 big bets position Intuit as a mission-critical platform to deliver end-to-end solutions driving sustainable growth. They say that we've made an early bet on AI. We have significant advantage with our scale of our data, investments in AI capabilities such as knowledge engineering, machine learning, and Gen AI, and our large network of AI-powered virtual experts. This is enabling us to disrupt the categories in which we operate. And this isn't just fluff. They have entire investor presentations, 30 pages long, where they detail all the effort they're doing in AI. The CEO continues on explaining their 5 big bets, and they're basically different ways that they're implementing AI into different aspects of the company and the products to further create a moat from Intuit and different would-be competitors. When I look at what Intuit's doing, I like the fact that the company's still in heavy reinvestment mode. They're growing quickly. When we look at the numbers of this company, the thing that impresses me the most out of every other metric is if we look at the free cash flow per share growth. Intuit is one of the fastest free cash flow per share growers in the market. Of all the different companies I look at, I'm constantly trying to do analysis on which ones can grow free cash flow per share the fastest. Intuit continually comes up as one of the top ones. They've grown their free cash flow per share at a rate of around 20% for the past 10 years. That is incredibly fast. That's much faster than my hurdle rate of 15%. So they are growing free cash flow explosively fast, and Intuit even raised their guidance on the full year for revenue and earnings. Now, Intuit is one of the higher multiple companies in my portfolio. When I'm doing analysis on different stocks I own, this one also shows up as a more highly rated company. It trades at a 34 forward PE if you use non-GAAP analysis. If you're looking at it from GAAP and factoring in stock-based comp, it trades more in line at a 50 PE ratio. They are getting stock-based comp under control. They're doing some layoffs. They're also cutting costs, but either way, this company is higher priced. So it's going to trade with more volatility than the other earnings. But as far as I'm concerned, looking at these earnings, looking at the progress of the business, I see no red flags here. I see a company that's well on track to continue generating growing free cash flow per share. Now moving on, we get to a report here that at first glance, I really thought it might be parody or fake news. I didn't know what to think of it. I had to verify it, but through multiple sources, it has been verified. Chick-fil-A is hatching a plan for streaming services as reality TV comes home to roost. It's a pretty good headline. I like it. A couple puns in there. Good job, Deadline. Now, that headline is correct. Chick-fil-A is planning a streaming service, and this has been verified. Now, why would Chick-fil-A do such a thing? Well, we can take a look at the report here. Yes, Chick-fil-A is looking to launch a streaming platform. The fast food chain has been working with Hollywood production companies and studios to create family-friendly, mostly unscripted original shows. The Chicken House is also in talks to license and acquire content according to the source that pitched the project. One of such programs is the game show from Glassman Media, NBC's The Wall, and Sugar 23, Netflix's 13 Reasons Why, which has been given a 10-episode order. Now, this is a little confusing. I don't think that Chick-fil-A is licensing from Netflix, and I definitely don't think they're licensing 13 Reasons Why. That doesn't seem like the most family-appropriate, fun, unscripted show. And also, Netflix doesn't license to other people. I've never seen a Netflix TV series on a different streaming service or different service altogether. Netflix keeps all of the content they own and make to themselves, and they license shows from other people back onto their platform, not the other way around. I'd actually be really shocked if Netflix starts licensing anything to anyone else. That would be a shocking change in direction, and I don't think they need to do that. But anyways, not to get sidetracked here, the budgets for unscripted are around $400,000 per hour, sources indicate. Chick-fil-A is also considering scripted projects as well. That seems like a lot of money for unscripted shows. We always look at unscripted shows as being cheap, but they're still almost $500,000 per hour, which I guess is lower than the average cost of like a drama. Let's be honest here, this is Chick-fil-A. When I go to a Chick-fil-A, it seems like one single location, the one that I'm at, is making $400,000 per hour. Chick-fil-A is printing money at every location. They're gonna have no trouble affording this. Now, they also are dabbling in scripted projects as well as animation, stuff like Top Gear and The X Factor, but we don't really know. These are all inside reports, things that they might be doing. Now, even though Chick-fil-A can easily afford this, it's still unclear why they're doing it. Streaming is a brutal industry to be in. The first thing required to be profitable in streaming is to have massive scale. Massive scale requires massive investments. You have to invest so much to build an audience, to get millions and millions of subscribers that don't churn off the second you stop producing content. And only a couple companies, in fact, I think 2 or 3 have achieved that scale or will ever achieve that scale. Companies like Disney, Amazon with Amazon Prime Video, and of course Netflix. And I think the biggest rewards by far will go to the very top companies. So obviously with Chick-fil-A, they're smart enough to know that they're never going to reach scale of Netflix or Disney. They don't have Amazon with Amazon Prime. They're never going to have hundreds of millions of subscribers. So what is the play here? What is the goal? Obviously they have a different intention. Chick-fil-A itself has yet to announce or publicly comment on the programming initiative, but a pivot into entertainment companies could be part of a bigger advertisement or customer data play. Disney does it with Disney Plus, and it drove Walmart's interest in streaming, which ultimately led to partnering with Paramount Plus. So obviously there's a bit of skepticism here. What is Chick-fil-A trying to get out of the streaming service? What are they trying to accomplish? The Verge suggests that it may be because of data. Chick-fil-A simply wants to accumulate data and extract it out of their customers and monetize it. That could be the play. Maybe they're willing to do that, but I don't think so. I think a company with the reputation of Chick-fil-A, the good standing they have with their customers and the relationship that they've worked decades to build, I don't think they're willing to forfeit that by doing a cheap data extraction program. That is short-term thinking. That's the type of thinking that would destroy a business like Chick-fil-A. I think it's much more likely that the goal of Chick-fil-A is to simply create a service centered around families. Family-friendly entertainment, lighthearted entertainment. Nothing highbrow, no huge drama series that are violent and riddled with sex scenes. None of that stuff, just family-friendly entertainment. Unscripted comedies, lighthearted comedies, things that parents can switch the TV to and not worry about what their kids are watching. Chick-fil-A is a company centered around Christian values. Right on their website, our purpose, in bold writing, they say is to glorify God by being a faithful steward to all that is entrusted to us, to have a positive influence on all who come in contact with Chick-fil-A. Now, obviously, these companies can put whatever they want on their websites, whatever sounds good, but when you go to Chick-fil-A and you get treated the way you do, it has a different feeling than most fast food companies. It feels different because of the way that it's ran. When I look at Chick-fil-A, I don't think this is going to be a data play. I don't think it's going to be a growth plan for the future. I think it's something to just enhance the brand and offer people a different entertainment that's more family focused. So again, I would have never guessed that Chick-fil-A would be building a streaming service, but this is 2024. Anything can happen. That's all for now. See you in the next one.